What's going on, everybody? Thank you so much for checking in. In this video, we're going to talk about how to maximize profits on your trades. So I know there's a lot of traders out there that struggle with maximizing their winners. Everybody tells you hold your winners longer and cut your losers short. And in this video, we're going to address just how to do that. So the best part about this strategy is that it actually works on all time frames. So whether you are a short-term trader, a long-term trader, whether you're holding a stock for a few seconds, a few minutes, a few hours, a few days, even a few weeks or a few months, you can apply this strategy and it works on all time frames. It's very simple. You've probably used the indicators before, but in this video we're going to show you how to use them to your advantage. So let's go ahead and get started. I'm going to move myself out of the way here, and we're going to start by talking about what indicators you need in order for you to apply the strategy. So we're going to go on here, and I'm on Think or Swim. And you can use this on any platform of your desire. Any reputable brokerage account that offers charting is going to have these studies. And these are the 10, 20, 50, and 100 and 200 day moving averages. So that is the 10, 20, 50, 100, and 200. Now, a lot of people will talk about using the simple moving average or the exponential moving average. We choose the simple moving average just because we usually hold stocks for longer than a few minutes. We hold them for a few hours, a few days. So we use the simple moving average because it doesn't move as tightly with the stock below, and that will make sense when we go into the strategy. The exponential moving average is much better when you're scalping. So if you're only planning to hold a stock for a few seconds at a time and you're just quickly getting in and out, then you want to use the exponential moving average. But if you're the type to swing or like to buy in the beginning of the day and sell at the end of the day, then you may want to stick to the simple moving average. So now that we have those lines drawn out, they're going to be these lines on our chart. They may be a different color on yours, and that's the 10, 20, 50, 100, and 200 day moving averages. So the 10 and the 20 are the purple and the blue lines. The blue line is the 10-day moving average, and the 20-day moving average is this purple line. The yellow line is this 50-day moving average. The 100 and 200 day moving averages are these gray lines. And obviously I labeled them by color. I made these the longer lines a less apparent color just because they're visited very little often. So before we jump into how to use the strategy, we have to talk about what do these moving averages even represent. So the 10, 20, 50, 100, and 200 day moving averages all represent the average price of the underlying asset or the underlying stock for X amount of days. That X you're going to replace with what these moving averages are valued at. So in basic English, this 100-day moving average, this light gray line, is currently trading at 435.45. So over the last 100 days, for SPY in this case, SPY has been trading at an average of 435.45 cents. So every day these moving averages will change as the market goes up or down. But guess what? The longer the moving average, the less change that's going to be. And the shorter the moving average, the more change that's going to be with any upside or downside move from the underlying stock. So this 100-day moving average, if SPY was to move $1 or $2 tomorrow, then that 100-day moving average is going to move less than the 10 and the 20-day moving averages in terms of value. Now the 10 and the 20-day moving averages measure the average price over the last 10 or 20 days. Now, it is a phenomena that happened over time that these moving averages became support and resistance points. So when I say support and resistance points, over time traders realized that often when a stock is trading above a specific moving average or above a specific price over the last X amount of days, that's the average price of those days, they realized that line can be drawn out and it can now act as a support point or a resistance point depending on if the stock is trading above it or below it. Let me show you what that means. So we're going to navigate over to Tesla here, and we're going to take the blue line, which is the 10-day moving average. And we're going to talk about it in this case, and we're going to talk about it in this case. So say, for example, you were looking at Tesla for almost a whole year and you were waiting for that bullish reversal. And you try to use the moving averages to spot that bullish reversal. So obviously nobody knows when a stock is going to reverse. Nobody knows when a stock is going to crash. Nobody knows when a stock is going to sell off or anything of that sort. Nobody truly knows. However, these indicators, the 10, 20, 50, 100, and 200-day moving averages, have been long used by institutional traders in order to spot reversals and maximize trades. So say, for example, you're looking at Tesla and you started looking at it here. You see that the stock moved below the 10 and the 20-day moving averages right here. So at this point in history, traders and buyers of the stock were no longer willing to pay what they were paying for the average of the last 10 and 20 days. So in this case, now Tesla is trading below those moving averages. And the longer the moving average that it breaks below, the more significantly bearish the stock becomes. So notice that the day that it broke below the 100-day moving average, which in this case was the last and final moving average available as a support, the stock sold off for weeks to follow and continued selling off. Now say you were looking for that bullish reversal. You were looking for your entry and you finally found a breakout point. So the stock is moved back above that 10-day moving average and you're like, okay, so now buyers are willing to pay more than what they paid for the last 10 days. This hasn't happened since the break here. So now you tell yourself, I'm going to get in on the stock and I'm only going to sell if the stock moves back below the 10-day moving average. Now, unfortunately, in this case, you got in at the break above right around 216.60 or 216, let's call it. The stock rallied, it looked really good. Now, you haven't sold or done anything with your position. You've only bought shares. And now the stock sells back off and you get out because the stock breaks back below the 10-day moving average. So although the stock made it above the 10 and the 20, there was not enough volume, and that was clear indication here on the volume part, but we're not talking about volume in this video. That will be covered in a later video. By the way, make sure you subscribe if you don't mind liking the video as well. Here in this case, Tesla moves back below that level and you're giving up hope. Okay, so the stock has moved and you got in at 216 at this breakout, you got out at 219 at this break. So you made $3 per share, but that's not much. Now you keep watching and you see the stock going, it goes up to retest that level, comes back down, goes up, breaks again, and you get in. Now you got in at 181 and you're hoping that once again the stock takes off on a rally, and the stock doesn't. Unfortunately, you got in at 181, 182, and you got out right around that same level, so you broke even. Now the stock moves again to the lower side, and finally the stock breaks out, and we're going to talk about how you can use this on all time frames in the later part of this video. But finally the stock breaks out, and now you get in because you're a patient trader who has been really disciplined to his strategy. So now you get into this stock and you are going to ride it just like you did here, and you told yourself, I'm not going to sell the stock unless it breaks back below the 10 or the 20-day moving averages. So here you get in, which, by the way, good thing that you sold at both these breaks, because now the stock is worth 50% less. So you got in at a much better entry, and now you get into the stock and you can ride it all the way as long as the stock doesn't break below the 10 or the 20-day moving averages. So what do I mean by the 10 or the 20-day moving averages? Trading is all about your own specific risk tolerance. Your own risk management is going to be dependent on your risk tolerance. So some traders will continue holding through the risk of a stock potentially breaking through the 10, and they will have their stop loss set at the 20-day moving average. So here in this case, you got into the stock and you ride it and you tell yourself, I'm not going to sell as long as the stock is holding above that 10-day moving average. And so you got in the stock at 114 and you exit the stock on this break here, which, by the way, this didn't even break. You can see that the stock broke and recovered, and you got out at 194. That's nearly a 100% gain, even though you missed out on these breakouts. So you were disciplined to your strategy and you cut losses where you needed. And that's the thing about trading, is that as long as you stick to your strategy, and the strategy has been proven before, even if you take small losses on it every once in a while, you have to wait for your strategy to follow through, which is why we have stop losses in the first place. So here in this case, this trader got in at 114, continued holding, got out right around 194, and he called it a day. So the stock pulls back, and you can see that the stock in fact pulls back below the 20 and the 10-day moving average. It even breaks below the 50 and the 200 once again, or the 100, and then you get in once again. You get in right here, and you can see that the stock once again rallies from 168 before breaking at 260. So that's once again a $100 gain with the same exact strategy that you applied before. So that's when we're looking at the stock on the longer term charts. So this is a great strategy for a multi-week or even a multi-month hold. You can even apply the same strategy on the weekly chart where it has a little bit more leeway. So obviously with the longer time frame, these moving averages are going to move less and less day over day. So they hold those positions for quite a while, and you can hold a stock longer. So for example, the trader who may have shorted Tesla on this break from 285 could have sold right around 151. So you can see that's a $137 gain on the short side or on the put side just following that same strategy. So this works on the weekly or the daily. Now when you're day trading, for example, and let's pull up SPY here for example, you can use this strategy as a great intraday strategy. So I know it's very popular these days for 0 days till expiration options, and many traders, they want to maximize that trade. So if you're in short-term options, which are 0 DTEs or maybe 1 week till expiration, and you want to maximize that day, then you can use it on the 5-minute chart. Notice how SPY here in this case, in the morning, it was a beautiful break. You could have gotten to puts the break of the 20-day moving average. This is the 5-minute candles. Attempted recovery, but came back down, and here it broke above. So here you would cut your puts and you may get into calls because you see volumes going up, and now you can ride this as long as it's holding above the 10 or the 20-day moving averages depending on your risk tolerance. So here in this case, you can ride the stock and you got in right here and you rode it up and you didn't exit till it broke below, which is right here. So you got in right around 446, you got out at 447, and if you know anything about short-term options, you know that is one heck of a gain just with that dollar move on SPY. Now, not all moves are going to be crazy. Some moves will be crazy. So this wasn't a crazy move. This was only $1. But check this out. On the put side here, SPY breaks below all of its moving averages. This is on the 5-minute chart in pre-market. And here in this case, you notice that this does not break above the 10-day moving average from all the way to this break. So if you got into puts at open at 448, you would get out of those puts right around 444.50. That's when the stock recovers back above its 50-day moving average. So here in this case, you can clearly see how without stress at all, which is why so many traders miss out on their stop losses, is because they don't know where to place their stop loss. So here in this case, you can see that without any stress at all, these moving averages do the work for you, and you always have to respect them. Here's a great trading tip that we take in our own group. We're in T right now. We're in AT&T, and we got out as soon as the stock broke above the 10 and 20-day moving averages. So this stock we're seeing is a stock that has historically been undervalued in the recent history. So we got in, and a great trading tip is if you are swinging a stock, if you are swinging especially calls on a stock or short-term options on a stock or even shares, only swing stocks for a bullish direction when they are trading above the 10 and the 20-day moving averages. If it's below those lines, then you know for a fact that for the last 10 or 20 days, the bears have been controlling that price action, especially if the stock is below all of its longer dated moving averages. That is very key to any swing. If you're swinging on a bearish side, so if you're swinging puts or you're shorting a stock, only swing stocks that are trading below their 10 and 20-day moving averages. That's if you are trading a bearish side position. So with that, I'm going to go ahead and leave you guys off. I hope this video was helpful. Please don't forget to subscribe and like.